It's Thursday, March the 9th. And you know, one thing I've noticing that's going on, and I know you've noticed it too, the tug-of-war between the bond market and the equity markets.
One says one's right, one says one's wrong.
One's pessimistic, one's optimistic.
There's some good data. Interesting enough, there's more, I won't say more bad data, but there's more less good, if there's such a thing, data coming out. And you're now seeing strategists now talking more about recession.
Yes, and the bond market realizes that this is going to be a slow grind as far as interest rates and inflation, and that it's going to be sticky versus the equity markets that kind of are whistling through the graveyard and all hunky-dory about that we'll soon be out of this morass.
The Federal Reserve Chairman this week talked and reiterated exactly what we've been saying
for about a year.
For a year now. He's serious about increasing interest rates. The inflation has gotten stuck in the 6% range. They want it down to the 2% range. They're going to get it down to the 2% range. And we got at least 3 more rate increases with the next one coming this month. And speculation now is that that's at a 50 basis point increase.
Yes. We thought they should have done 50 basis points in January, but it looks like that I guess that's on the table anyway. So it wouldn't surprise us at all to see a 50 basis point increase when they do that in March.
The upside to this with monies that are maturing, that we've built these ladders for you. They're maturing now with rates that we can renew in the 5% range.
3 month and 6 months.
So we have that as a solid base. We still hold the list of stocks we want to get into. Had a little conversation this morning about possibly the small cap area as at the right time, a lead to get into possibly. So the opportunities are out there. The select sectors of the equities we're giving consideration to. But right now, for probably this second quarter, grab 5% and let's watch things and let's see where we are when we come summertime.
Because the S&P had a really nice January, but February was not so nice.
Right.
So a lot of the gains were completely washed away. So we think this is just sort of the game plan for 2023. We're going to see some good months and bad months, probably go lower from where we are right now. And as you said today on the show, wouldn't surprise you at all if we ended up right back where we are right now at the end of the year with maybe just eking out a little bit of a gain.
So if we could set expectations, protection is the thought process of what we're trying to do. Getting yield is where we want, avoiding risk, and getting to look for opportunities as they present themselves with some opportunity. We would hope by the end of the year with some upside, but protection of accounts is what we're about.
That's right. Mitigation is our number one goal right now.
We will be back into a time when we will be sitting here and saying the stock market is hot as a firecracker and it's the place to be. And, hey, what about this sector or that sector?
Because I'm ready to talk about something other than T-bills.
That's right.
I really am.
It cycles through, folks. So as you are with us, you're patient, continue it, and we will be here for you looking at this each and every week. If you have any questions or concerns, you can call us always. We do this because we know that's what we should do for you because it is your money.
And your money matters.
See you next week.